S. Naren, Chief Investment Officer with ICICI Prudential AMC. Naren, fantastic to have you back and thank you for joining us. The consensus call is that there are problems, there are structural problems, there are cyclical problems. India is underperforming China and we are staring at a wall of worry. So is the Mr. Contrarian now thinking about buying?
Yeah, clearly I think we are thinking of buying or recommending that equities is safer today when expectations have been brought down. And this is particularly true in large caps where the correction has been swift and substantial in many companies. So I would say clearly we are in safer period for long-term investment compared to what it was in the last 1 year, when there was certainly some amount of euphoria. I think that euphoria has got replaced to fear. Having said that, I think everyone looks at the lens of stock market between what happened between September 2013 and March 2015, and I have to point out that returns of more than 20 to 30% per annum on a consistent basis does not happen. So, while you can be positive on the market, you have to still reduce the return expectations. And what we got between September 2013 and March 2015 was a combination of India's macroeconomic situation improving drastically, particularly current account and inflation. You had the situation whereby we had an election result which was very beneficial for the markets, and crude oil falling. So I think we have to invest in equity but expect clearly lower returns than in the past.
Naren, morning. I think last year just spoiled all of us with those big bang returns that most investors made. But the point is, what do you buy then? I mean, how do you pick out those few select names which are going to perhaps give you more than that 10-15% which the average market would?
First of all, I think 10 to 15% if you manage to get is not a bad return. So, if investors are going to invest in equity always assuming 20 to 25% return, that is a problem. While the endeavor would be to try to get maximum returns, it's not always possible to get very high returns. Clearly, to make exceptional returns, you need to see fear in certain areas. Today, frankly, if you ask me, there is fear in some of the leveraged infra names and some of the weaker PSU banks. But both these areas appear to be risky even today because you don't know how the problems will get resolved. Another area of fear or disinterest is clearly metal stocks and some of the PSUs in the non-banking space. Clearly, I think there is an opportunity because there is fear there, but there is not so much of a fundamental worry. So we think that area can see maybe better returns because people are just not willing to look at that area. And so that would be one pocket we can think about. Other than that, what we find is many of the sectors are reasonably priced. Some of the large cap consumer names and pharma names have corrected that no longer can you make a case that the sector is expensive across the board in the same way. And the other sectors like private sector banks or some of the auto names, they are all reasonably priced, but at the same time there's no fear in them. So frankly, you'll get moderate returns. That's our view in most of the market.
Okay. And Naren, the very interesting action that we're seeing in the last 1 month or the last 3 months is that for every penny that is being pulled out by the FIIs, the DIs are pumping in money. Maybe May was a slightly soft month, but has June been okay in terms of the fund flows into your funds? And are you deploying cash almost on a weekly or a monthly basis?
See, clearly one is that, there was a 7-year window where you didn't get money between 2008 and 2014. So obviously there is scope for many years of inflows. That's point number one. Point number two is, see, what we've done as a mutual fund is we have what we call as defensive equity strategies like our balanced advantage fund and dynamic plan, where there's a lot of cash whenever the markets rally. So, whether we get inflow or not as the market corrects, we have the cash to deploy in them because that's part of the strategy. And I would say that inflows have been continuing into domestic mutual funds, and I think it is a multi-year trend. I'm worried that the trend might slightly reduce in intensity, but I think there is huge scope for people to invest money in equities, given that in the 7 years between 2008 and 14, the quantum of money people invested in both deposits and real estate and gold is so high that for equities to normalize as a part of asset allocation, there is got to be at least 3-4 years more of flows like what we received in the last 1 year.
Naren, if you look at the two global problems which are staring at us, one is Greece and second is Fed. Which is a better one, which is a bigger one, and which could have far-reaching implications?
See, actually, I'm of the belief that if neither of these problems have long-term implications, they have implications for traders, certainly. And the traders will have to watch both these events over the course of the next 3 to 6 months. But I think the implications are not necessarily long term, particularly in the case of Greece. I think when we speak to people, market has kind of reconciled that there will be a problem in Greece. Unlike in 2011-12, the loans are now not outstanding from any of the listed banks. So consequently, the problem is likely to not result in a big problem for a period of time. Having said that, will it create volatility for a week to 1 month? Certainly, I think, and that will clearly happen. And that we are kind of more or less prepared for in the kind of market view that we have. As far as the Fed is concerned, I think the Fed has been guiding beautifully that they will be able to increase rates and they will want to increase rates. But unless Fed starts increasing rates very sharply, I think the market has kind of got reconciled to the fact that there will be small increases. For a country like India, which has got no current account deficit now and has a big interest rate differential against US, I believe that this small change in US interest rates is not likely to have a big impact. The bigger impact is going to happen in the countries with high current account deficits and the countries who have zero interest rates. Because when zero interest rates prevail in a country and US increases rates to 0.25, the gap increases from 0 to 0.25, which is large. If from an India point of view, the gap will come down from 7% to 6.75%. So that's only 3%. So I think the impact is not going to be sharp on the first rate hike. But if there are going to be 8 rate hikes or something like that, then I think the impact will play out over a period of time. And in my opinion, the Indian Reserve Bank has been working so hard to create the cushion to handle this situation on US Fed. So, you know, the foreign exchange reserve that we have today is $350 billion almost. And when our current account deficit is almost zero. So I think we are very well prepared. I think the real issues in India are the problems in the infrastructure sector and the fact that real estate, because it is expensive and many of them have not managed to deleverage. If the infra and real estate sectors get deleveraged, maybe using rate cuts or some other issues that government comes out, I think India will emerge very strong.
So, Naren, you know, in continuation with that thought of yours, assuming that the Fed in its recent meet does indicate a 25 bips hike and the fact that it's convincingly coming out with a rate hike in September, what do you see from the RBI governor? You say that up until now the governor has provided an apt cushion. Do we see any rate cuts coming in into India for the latter part of the year, or do you think it's going to be a bit of a vacuum for now?
See, our view is that if monsoon turns out to be normal, the way it is shaping up, last 15 days has been normal, and you have the rate cut, and it is proved that the rate cut doesn't have a big impact on global macro. See, on Indian macro also, I think the RBI may consider rate cuts in the second half of the year. So, of course, if US Fed increases rates and 4 or 5 countries have huge volatility, then maybe the rate cuts won't happen immediately. But our view is that India will see lower rates, and when the rates will be brought down will be determined by the Reserve Bank's assessment of the situation. And I think the precursor to all these things would be that we have to have a moderately good monsoon. If you're going to have a very bad monsoon, then then the bets are off. But I think right now the first 15 days and the outlook for the next 10 days seems to indicate we are on a normal monsoon, and surprisingly the market has not reacted to the normal monsoon so far.
What about earnings, Naren? Because till about a month back, the key concern was earnings have been horrible, and there is still, a big question mark on monsoon. Monsoon, at least as of now, fingers crossed, seems to be playing out better than what anyone expected. But what about earnings? Is all the pain in the price? Do we bottom out from the previous quarter, or is there more pain to go in terms of quarterly performance in the next quarter as well?
Yeah, we have been of the view that earnings till September are not likely to be good. That means till the earnings season, which comes in October. And this year, I think the Diwali is slightly delayed. So, the outlook for earnings for the June quarter and September quarter doesn't look good to us. I think the outlook for the second half currently looks decent to us. But if the monsoon comes out bad, then we'll have to review it. So I would say that it's very difficult to give an earnings view for a long period of time. For 2 quarters, it's certainly not good. And in our moderate return expectation of the market, I think we have already inbuilt the fact that for 2 quarters earnings won't be good. The second half of the year, when will the earnings pick up? That's a question which we are debating internally in our team. And we have not yet come to final answers, but we do know that a normal monsoon would clearly accelerate the earnings recovery, and a very bad monsoon would delay the earnings recovery. And we are right now in a phase where we can't be sure on the monsoon.
Okay, so Naren, with you, we always love to get into the deep value arguments and when there is value in the market. Last time you told me that there was deep value in some of the distressed rural-based companies, or companies which largely derive bulk of their business from the agrarian economy. So Naren, if I put a graphic which says that there is deep value in rural companies, non-ferrous metal stocks and PSU banks, is our assessment right?
Yeah, absolutely. But right now, if you ask me, the non-ferrous, see, in PSU banks, the infra bad debt problem has to get resolved, and at least the resolution process should start. And unfortunately, the way some of the leverage companies have fallen in the stock market has clearly caused it to delay. So I would say that that is looking very deep value, but you need to have the ability to stomach the risks associated at this point of time. To me, non-ferrous metals look very easy because those sector has been out of favor for 7 years. It's under-owned, cheap, and investor expectations virtually don't exist in that sector. So I would say that's one of my most interesting areas. Surprisingly, ferrous metal stocks which are not integrated are also looking very interesting, because iron ore and coking coal have been crashing, and that affects the integrated companies rather than the efficient non-integrated ones. So I would say these are 2 pockets where I see value at this point of time. Regarding rural players, I would want to watch the monsoon a bit more and then come to that conclusion.
Wonderful to have you back on ET Now, and thank you for joining us, and look forward to seeing much more of you going forward.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.